This is ACC Amit Kumar and will discuss with you IAS 37 contingent liabilities, contingent assets, and how the provisions are to be dealt with. When can we create a provision? When can we not create a provision? So this was a standard which was actively used for creative accounting. Entities were creating provisions when they were not supposed to create a provision, and they were not creating a provision when they were supposed to create a provision. So this standard clearly clarifies that when an entity is eligible to create a provision. So the three things to add. What is the difference between a liability and a provision? Anyone?
Liability is sort of certain thing, but the provision is not. We cannot. We are not certain about what would happen if it would not happen, whether we are going to get our money back or not for the say borrowers, or we are going to get our all debts cleared without any fault on that.
Very perfect. So liability means we know the amount to pay. So it's certain amount. We know the time to pay at a certain time. We create provision when we are not aware of one thing. We know that we have to pay, but we do not know when to pay. Or we know the time to pay, but we are not sure of the actual amount to repay. So when there is one uncertainty that either amount or timing is uncertain, we are required to create a provision. So provision is kind of a liability, it's very closer to a liability, but there is no certainty. There is a likelihood of payment. Certainty is in the terms of probability of payment, that we are bound to pay. If there was no certainty in terms of payment, then it would have been considered as a contingent. Contingent means the occurrence or non-occurrence is dependent on future event. It may happen, it may not happen. This is something which is neither amount or timing is certain. We do not even know what amount we'll be paying. We don't even know when we'll be paying. So it is a contingent liability. It's actually a journey in the life of that item, that something may be contingent today, but if the probabilities are clear that we are liable to pay, but we do not know when to pay, or the timing is clear that we have to pay after 5 years. Mainly in the case of court case, like there's a court case which is going on, and the lawyer says that, lawyer is very confident because he says that we're going to win the case and will not be paying anything. But we need to disclose the variability relating to this case as part of our disclosures in the form of contingent liabilities, that we may be liable to pay, but our lawyer is very confident that we will not be paying anything, and the chances or likelihood of winning are much more. After a certain period, lawyer may say that the chances of losing are more, but I'll try to defend the case as much as possible and will try to minimize the liability as much as possible. So the item shifts from contingent liability to provision, that we may be liable to pay some amount and the probabilities are higher now, but we do not know how much amount to pay. So we, on the basis of some probability, we create some liability in the form of provision in the balance sheet, that we may be liable to pay this much of amount, because our lawyer says that at least he'll be able to defend the case and our liabilities will be minimized. Then the occurrence of the event happens that the court declares that the entity will have to pay 5 lakh after 2 years. So suddenly that provision turns into a liability. So it's actually a journey. Why do we need to create a provision? That if we do not create any provision and suddenly if that liability arises, the shareholders will not feel good about the move of the company, that there was a liability of 50 lakhs and suddenly it gets disclosed in the books that we are liable to pay this amount, and which hampers their decision making. So it's better to create a provision than not to create a provision. That if you're liable to pay around 5 lakhs, and even if you create a provision of 3 lakh, 90,000 or 4,50,000, that is still better than not disclosing any amount in the form of liability in the balance sheet. Though this is not certain amount, this is not the actual amount, but it is still helping us to give a fairer presentation in the market. So is the reason we create provision. And how do we create provision? We create provision on the basis of most likely amount and most likely amounts and expected value method. Most likely, as I discussed, the same thing I can use in terms of creating a liability now. That how much is the expected provision I need to create? If I have large number of probabilities, I'll be using expected value method as a method for knowing this probability. But if I have very few probabilities and I know the most likely amount among them is going to be 3 lakh, there's a probability that the chances of happening 60% are 3 lakh, chances of happening 20% that we will be liable to pay 3 lakh. The chances of liability are 275 20% or 325 or 10%. The most likely amount will be chosen to create a provision. And if the probabilities are higher, that the probability of paying 3 lakh 25 is 25%, the probability of paying 3 lakh is 20%, 275 is 15%, then in that scenario, we use the expected value method as a technique to know the amount of provision to be created. So even if you create a provision of 285, and if the actual result is around 3 lakh or 3 lakh 25,000, it is still better than not creating or not showing any amount in the balance sheet, because we have at least shown a liability or a provision of 285 500. We have informed the shareholders that we may be bearing this amount. And if we do not have any amount or timing, then at least we inform the case to the shareholders that this is the scenario, this is the case which is going on. We are not certain whether how much amount we'll be liable to pay. We are fighting or defending the case. The financial impact of this can be this much. We disclose some notes to accounts because we do not have any amount to be recorded in the balance sheet. In some scenarios, we may also be in a situation wherein we have onerous contracts. Onerous contracts. Onerous contract means the entity is going to suffer a loss in any situation. Suppose the entity entered into buying gold for price of 30,000. Market price is in future market price lowered down to 28,000. But if they reject the order, there'll be a penalty of, suppose they entered into a contract to buy 30 lakh worth of gold. And if they do not entertain the order because the market price has fallen, they can purchase the same at a price of 28 lakhs. But there was a penalty clause that they'll have to bear a penalty of 2.5 lakhs, or it could be 1.5 lakhs, whatever. So if they entertain the order, they'll be suffering losses in comparison to market price. If they don't entertain the order, they'll have to suffer a penalty. So in any situation, they'll have to bear the loss. So what is decided? Whichever gives them lesser loss, whichever minimizes the loss, will be the next action taken by management to minimize the loss. But this contract turns out to be an onerous contract because they'll have to bear the loss in any situation. In other scenarios, how it is related to other assets is dismantling, decommissioning, restoration costs. If you remember IAS 16 property, plant and equipment, there was some dismantling, decommissioning or restoration costs which are supposed to be incurred. If we enter into buying a factory, a machinery, There may be restoration requirement that if we are establishing chemical factory, we may have to restore the land, restore the site before we leave. If we dismantle the property, there is some dismantling cost as well. So when we are buying this property, plant and equipment, and if it is costing 500,000 and there is expected dismantling cost of 200,000 after 3 years, we need to include the present value of 200,000 today as part of cost of the asset, capitalize it. At the same time, create a provision for dismantling for the same amount, that is present value of 200,000 today. If I take the rate of 10%, if I assume the discount rate at which we discount it of 10%, and for 3 years time discount factor $0.753, so the present value today at which it will be discounted included in the form of provision will be 200,000 into 0.7513, and the same amount will be included as part of the cost of purchasing the asset. Now at the end of each year, whatever we discount to present value, this provision for dismantling at the end of, so this is at initial recognition, at the end of the year there will be unwinding of discounts. In IFRS, remember that whatever you discount to present value, please do not forget to unwind the discount. So provision for dismantling will be increased at the end of the year by 10%, and this will be now 150,263 into 1.1. The amount will be 165. The difference 165 minus 150,263 is charged to P&L as unwinding of discount cost, or indirectly interest expense. So this is the accounting treatment which is done relating to PP and also a provision relating to it. Apart from it, we are required to create restructuring provisions. If the entity decides to restructure their business and lay off some employees, or if there are any termination costs or redundancy costs, whatever is the liability on the day of deciding, but they cannot recognize provision simply by thinking about it. If they have a clear plan, if they are planning to initiate the plan, if they've decided it, so whatever is the expected liability which may arise on the basis of estimates of initiating the restructuring process, they're required to create a provision for restructuring as well, on the basis of when they are required to pay. If they're going to pay after 2 years, 3 years, they need to discount it to present value. If they have to pay something immediately within 1 year, they have to record it at present value amounts what they are liable to pay. Contingent assets and contingent liabilities. Contingent asset or contingent liability. Contingent asset will be very conservative in our approach. We may not be even required to disclose those contingent assets. Contingent liabilities we are required to disclose in the notes account because we do not have any amount to be shown as part of the balance sheet. So this is a clear difference between liability and provision. Provision becomes a liability in future. Contingent liability becomes a provision if we are somewhere reach a level wherein we are probably able to estimate the amount which we can recognize in the books. So we apply IAS 37 for provisions, contingent assets and contingent liabilities. It addresses provisions that are liabilities. The standard addresses only provisions that are liabilities, not provisions for depreciation, doubtful debts, because they are taken care of by other assets. Provision for doubtful debts is taken care of by IFRS 9 financial instruments. Provision for depreciation is taken care of by the standard on property, plant and equipment. So it is taking care of the provisions for liabilities. The reason, as I said, I talked about the journey from contingent to provision to a liability, not taking care of the asset side. Because that those amounts can be netted off from the amounts. Provision for doubtful debts can be netted off. Provision for depreciation can be netted off. If you're not creating a separate depreciation, we can record them at book values. So they are liabilities of uncertain timing or amount. Now, what is the liability? Liability is a present obligation as a result of past event. You entered into some transaction in the past, which will result in present obligation. What is your liability today? The settlement of which will result in outflow of resources. There will be money flowing out of the business, and it is embedding economic benefits. Obligating event can be legal or can be constructive. Legal means required by law. Constructive obligation means that you have done something in the past. That your company, when they established a chemical factory last time, and when you left the site, you planted trees, you restored the site. If you again set up a chemical plant somewhere else in the country, it is a constructive obligation that this company, when they last time did it, they cleared the site, they restored the site, they also planted 1 lakh trees on the site. So this automatically results in a constructive obligation that in future, if you enter into such transaction, you're definitely going to follow what you've done in the past. So it has been your past practice. So you're required to create a provision even today, even if it is not legally required by law. Legal obligation derives from a contract, legislation, or other operating law. That law says that if you leave the site, you'll have to restore the site. And if you have to restore the site is obligatory, then you have to create a provision under legal obligations. Constructive obligation which derives from an entity's actions where established pattern of past practice or published policies you have done so in the past, which creates a valid expectation among the minds of the shareholders or the people in the locality or the government that you are going to do it again. So the other parties are reasonably sure the entity will discharge these responsibilities, and non-performance will lead to a fall in credibility of the company. So if they don't adhere to it, definitely company's credibility in the market is going to get hampered. They're trying to project themselves as green company, but if they don't do it, definitely their image is going to get tarnished a little bit. The 3 conditions need to be satisfied for a provision to be created. Unless all the 3 conditions are not satisfied, a provision cannot be created. It has to meet all the 3 conditions. That there is a present obligation as a result of past event, and there is a probability. It's not a clear-cut liability. If you notice, there is a probability that resources will flow out to the entity to settle them, and obligation can be estimated reliably. If you're not able to estimate it, it cannot be considered as a provision. It will remain in the category of contingency. Journal entry will be simple, that you recognize an expense in P&L account and you create a provision for expense. You show it as part of your balance sheet. When you settle this, there'll be a difference. Your provision for expense gets debited and you make the payment. If there is any difference, because since it's your provision cannot be actual amounts, if there's any difference, that will either be a credit in P&L or either will be a debit in P&L. Either your expenses will be more than the provision you have created, your expenses can be less than the provision you have created, will be settled in the P&L directly on settlement. Amount provided would be the best. Yes.
Sorry to bother you. Can I go back to the previous slide? Yeah. So I am just assuming, like, how is it different from the reserve in this scenario, as where we are making a provision for the expense, as you are aware there is a bigger expenditure to make reserve for, say.
Banu, reserves and surplus is a choice, is an appropriation of profit. This is not a choice. This you are obligated to pay. Whether you like it or not, you'll have to pay. Okay.
Okay.
When you appropriate your profit in the form of reserves and surplus, that you want workman compensation fund, you want dividend equalization reserve, you want an asset repurchase reserve.
Yeah.
That is an appropriation of profit. That is a decision by management, which they can decide how they're going to utilize the retained earnings. They may be directed by regulatory authorities or they may be done by intention of management. But this is not a choice. You are obligated to pay some amount in future. You're not certain of, or certainly sure of how much amount to pay, when to pay. You need to estimate the amount you are liable to pay in terms of a provision, and you have to record it as part of your balance sheet in the form of a liability.
Okay.
So you're charging it to P&L today. So your profits are being lowered down today. because you have created a valid expectation that you're going to meet this in future. There is a constructive or legal obligation. So you form or build up a liability to be able to repay it. And you built it up in the form of provision for expense. When you repay it, you're able to settle it because you've already charged it to P&L. You've already reduced it from your profits. That's where creative accounting was happening. They were charging these provisions when they were not supposed to. They were not creating when they were supposed to. Is being rectified through this standard.
Okay.
So we'll use the best estimate, experience from similar transactions, evidence from experts, judgment of management of entity. We'll take into account inherent risk and uncertainties around it. And size of obligation will also include the time value of money, that if it is going to be paid in future, we'll discount it to present value. And expected future events or change in legislation, improvement in technology. Today we are creating a provision because of constructive obligations. We may create it, we may not create it, but in future it may be required by law that even if we do not wish to, we'll have to create that provision. Provisions are reviewed at the end of each year. We'll adjust the amount. So our provisions may increase or decrease because of this reviewing. Reverse if an outflow of resources is not probable anymore. So we may reverse the entire amount if we are not required to repay, or the judgments are in our favor, we are not required to pay any amount, it may be reversed as well. Reimbursements. Now, if an entity is virtually certain that another party will reimburse the expenditure required to settle this liability, you are simply acting as a medium. You know that you are creating this provision because since you are the medium by which this payment will be done, but you'll be reimbursed for it. Then this amount is recognized in the following manner: as a separate asset in the statement of financial position, deducted from the amount of expense, and the net amount of expenses transferred to the income statement, because you may be getting benefit out of it that some other party will reimburse to you. So you can create an asset of what is receivable. It cannot exceed the amount of provision. Reimbursement amount cannot exceed. You cannot show as part of your incomes that you have generated income out of these expenses which were reimbursed. Reimbursement can only happen to the extent of the expense you have recorded in your balance sheet. If there is an insurance for it, or if you are secured by an insurance and there is a probability of receiving that insurance, then your provision amount gets reduced because of it.
Amit, one question. Here it is written it as we have to show it separately as an asset in financial position. But the reimbursement, if the timing is same, then we can do the netting in balance sheet as well, right?
Yeah, netting in balance sheet, because our expense will be always higher. And as I said, reimbursement amount cannot exceed the amount of provision.
Yeah, that's true. But the liability, can we show as a net?
Yes. Yes,
Can show
as
it.
a net.
Okay. Yeah. Okay.
Only if it is virtually certain. Virtually
Yeah.
certain, the likelihood of it happening is more than 90%.
Yeah, I think that is most critical word. Virtual certain.
Yeah,
And
virtually certain is very
yeah.
critical.
Yes. Yeah.
Okay. Decommissioning, as I discussed, these costs should be recovered as soon as an obligatory event occurs, like cost of removal and restoration. A provision may present delayed expenditure that is necessary in order to achieve access to future economic benefits. If this is the case, then it should be capitalized as an asset. Like any restoration, cost of removal are these are mandatory for purchasing an asset, because if you don't agree to these restoration and removal costs, you'll not be allowed to purchase the asset. So to be able to use the asset, you need to agree to these costs, and if you agree to these costs, you become liable to incur these expenditures in futures. And if you become liable to incur these expenditures in future, if you do not know the amount, you need to record it as a provision today. Will not provide for provisions for future operating losses. If this is allowed, then I'll never show profits, and I'll ditch the income tax department every time that no, I don't have any profits because I'm going to suffer losses in future. So this is not allowed. Currency risk, political risk, maintenance, or refurbishment. I plan to make changes in my office. I plan to paint the entire building, and the planning of painting the entire building will cost me 10 lakhs. I want to create a provision for it. General restructuring projects, which are normal projects which are not creating any valid expectation among the minds of the employees, or that restructuring is not creating any liability on your term, which is part of your normal routine work. General business risk, all these cannot be provided for. anything happening in future, anything happening in future which may result in losses will not be taken as an excuse for creating a provision. Onerous contracts, as I said, in which the unavoidable costs of meeting the obligation exceeds the economic benefits expected to be received, you are going to suffer a loss in no matter what condition. So there is a present obligation to be recognized. It will be lower of fulfillment cost, that you plan to suffer a penalty or you plan to complete the order. So any compensation or penalties arising from failure to fulfill it, or if you fulfill it, that if you go with the order, you will suffer a loss, or if you do not go with the order, you will suffer a penalty. Whatever is the lower will be your present obligation as a result of past event. Restructuring provisions, as I said, a program that is planned. It should not be a wish. Planned and controlled by management and materially changes either scope of business or manner in which the business is conducted. It may be termination of business, it may be closure of business or relocation from one region to another, change in management structure. All this will result in cost. All this will result in some obligations of the management when they take these decisions. So if there are some obligations because of taking these restructuring provisions, if it's planned, controlled, they are bound to pay to some parties, they need to create a provision for it. So a constructive obligation to restructure asset arises only when restructuring provisions require a detailed formal plan or a binding sale agreement. If they're committed to it, it's not just a plan, they're committed to it, there's a formal plan, and it must illustrate a demonstrable commitment. So it should not be by a mere wish of the management. They should have a plan, commitment, they should disclose the starting to implement that plan, announcing its main features to those affected. So according to IS 37, restructuring provision should include only the direct expenditures arising from restructuring. Direct expenditure means that only which will result in this restructuring and which will result in a obligation because of these restructuring. Now, if you plan to retrain or relocate continuing staff, that is not an obligation of this event. That is part of the new process. Marketing cost or investment in new systems and distribution, and that is not your restructuring provision. So necessarily required by restructuring and are not associated with the ongoing activities of the entity. So if they are going to hamper your ongoing activities and some parties will demand payment from you because of this decision of restructuring, you're obligated to pay them. But if you plan to retrain them, relocate them, marketing cost, that is a new activity, new thing happening, new decision that cannot be related to this restructuring activity. You cannot add all the costs as part of restructuring activity because you plan to retrain or relocate them. An airline is required by law to overhaul its aircraft every 3 years. Now there is no refurbishment cost, as I said, that if you plan to do something, no present obligation for future repairs or refurbishment, because it is possible that when an overhaul is due, you may sell that asset, you may decide to stop using it, you may decide to use it without even overhauling it. So overhaul cost is not a provision. There is no obligation as a result of past event. You may incur that overall cost. If you wish to maintain your aircraft's capacity, you overhaul it. If you do not wish to maintain your aircraft's capacity, you may not get into it. So overhaul should not be confused with creation of provision. Overhaul is an asset which depletes in value. There is an aircraft whose value is 20 million. It is divided into various components: engine, overhaul, body parts. Engine has a value of 10 million. Overhaul has a value of 4 million, and other body parts has a value of 6 million. The aircraft is required to get an overhaul after every 4 years. This engine will be depreciated over a period of 5 years. Body parts over a period of 5 years. Now this aircraft will be divided into various components and each component will be depreciated separately. Now this overhaul is not physically seen, but this overhaul is a component of the aircraft. This is considered as a separate component asset of the aircraft, and this is going to get consumed over a period of 4 years. So we'll depreciate this overhaul over a period of 4 years, and after 4 years, what will happen? There may be next overhaul due. and next overhaul due will incur again a cost. Suppose the cost of overhaul resulted in 5.5 million, and this will require another 4 overhaul after 4 years. So we cannot create a provision today at the end of 4th year or at the beginning of 4th year that we'll have to spend 5.5 million, because this 20 million we spent when we purchased the aircraft. But at the same time, we cannot create a provision of 5.5 million that after 4 years we'll need to spend around 5.5 million. There's no obligation to do so. You're not obligated to incur this. That is a choice. If you want to maintain your aircraft, you'll have to incur this cost. If you do not wish to maintain your aircraft, you may sell it, you may stop using it, whatever you do. This doesn't create a present obligation as a result of past event. So many of the times people get confused between overall cost as a provision because we are incurring some expenditure in future. Remember, provision is a present obligation as a result of past event from which future economic benefits are going to flow to the entity. And as I said, all the 3 conditions need to be satisfied. This is not meeting the condition of being a present obligation. So this is not a provision. Overall cost should be capitalized and depreciated over 3 years, which will spread over its useful life rather than charging it to P&L in a single economic accounting period. Because since it is a significant cost, 4 million is a significant cost, we do not charge it outrightly in the year of purchase. We spread it over all the years which benefit out of it. Hope this is clear. And this also makes it clear in regard to PP overhaul cost. So there are 2 things into it: major repairs and maintenance and overhaul costs are considered as separate components as per IS 16 property, plant and equipment. Routine repairs and maintenance form part of profit and loss account as expenses.
Amit,
Yes.
one thing. For that overall due 5.5, we are not going to create a provision for this expenditure which is going to happen after the date.
This is actual cost. This is actual cost which is incurred after 4 years.
Yeah. So
And
we are not going to create a provision.
We are not going to create a provision because this is actually being spent and this is going to be depreciated over the next 4 years now.
Yes.
After the next 4 years, it may happen that we have spent 6 million now.
Yes. So but will a provision for depreciation will be created?
Provision for depreciation will create, yes.
Yeah.
So we'll disclose the carrying amount at the beginning and end of the period. If there is any new additions, existing provisions, amounts used, amounts reversed, increased during the period of any discounted amount arising from the passage of time, that is unwinding of discount, brief descriptions of our obligations, expected timing of expenditure, nature of uncertainties of the amount or timing of outflows, and amount of any unexpected reimbursement with details of asset recognition, that if there is any reimbursement which may happen, we'll give a details of how we are going to get this reimbursement, how it is going to reduce our expenditures or provision. We need to disclose all what is happening relating to them. Next is contingent liabilities. Now, as I said, contingent liability is an uncertain, neither the amount is certain, neither timing is certain, but since it exists, that the occurrence or non-occurrence of a future event can result in some outflow of economic benefits in future, but since we are not aware of the amount, we need to disclose this fact to the shareholders. So possible obligation. So there's a difference between probable obligation and possible obligation. See, the words are being used very cleverly. Possible obligation may happen and is dependent on future occurrence or non-occurrence of an event. So present obligation that exists arises from past events, but it cannot be recognized because no probability of outflow of resources, amount cannot be estimated reliably. Since we cannot record anything in the balance sheet, we simply disclose the fact. Not provided for in the account, this means they are not reflected in the financial statements, but they are disclosed in the form of disclosures. Yes, Manu, you were saying something?
Yeah, I'm just going to take one more minute of your time on the provisions. Just going back to that, if there is a case of say operating lease where we have given a certain asset on lease and we are going to create a provision for depreciation on that, and we are going to create a provision for say the credit risk on that, as we are not sure that we are going to
So Bhanu, in IFRS 16 leases are clear liabilities which are shown against right of use asset. If you have committed to use an asset that is forming part of your asset category, and whatever minimum lease payments you're committed to pay that are known, you show them as part of your liabilities, as part of your balance sheet.
Yeah, from the lessor's perspective.
Yeah, from lessee's perspective as well, we are showing liabilities. Lessee is the party who brings in that asset in the form of right of use. They show a right of use in the asset category. Whatever minimum lease payments they've guaranteed, they show as part of their liability. So that is not a provision actually. We are able to estimate clearly the amount what we are liable to pay in leasing.
Yeah, yeah. So if I'm just asking if there is a certain default in the payments of that, say if we are going to receive say 10,000 rupees a month
If we are going to default on payments, I think that's not a concern for us. That is for the other party.
Yeah, from the lessor's perspective.
From the lessor's perspective, if there's any default, that is subject to testing for impairment on
Yeah.
the expected flow of benefits. Definitely, that will be subject to impairment.
Okay, so we'll create a provision for that. Or
We may create a provision. Will not actually that we will be. That is an uncertainty on the receivable amount. So that is doubtful debt for them indirectly.
Yes.
Okay. See, provision is a liability. From lessor's perspective, they are not going to receive that amount. So there is no liability of the lessor.
There is no liability on the lessor, but it's a doubtful debt.
It's a doubtful debt that the assets got impaired.
So that will be covered under IFRS 9.
Yes, right.
Right, got it.
So again, I repeat again, provision is a liability.
Yeah.
If you believe
Got
that you're required to repay because of your present obligation as a result of past event, if you're required to pay any amount, and if you're unsure of the amount, you're unsure of the timing, please estimate it and record it as part of your balance sheet that this amount may arise in future.
Fine. So there will be two things for the same asset, say for the same assets leased out. So one is the provision for depreciation, which is a liability, right? Which will cover under this.
Depreciation is not a liability, is the reason it said provision for depreciation is kind of an account created to see the movement of depreciation which is being spread. So it is a netted amount on the asset side only. It is not shown on the part of liability side. Is the reason it clearly said that these are not provisions.
Right.
Mentioned somewhere, I guess. See, I said this, not provisions for depreciation, not for debts. This is standard applicable only to liabilities that are liabilities.
Got it.
Not the provisions that are created for assets.
Right.
Or created for impairment. Okay. But it's good to ask these questions because they clarify accounting to the core level. So I'm happy you are asking such questions. So contingent liability is clear, I guess. We simply disclose the fact. Contingent liability exists whose settlement is not remote, then entity has to disclose brief description. Remote means no likelihood, nothing will happen in this regard. An estimate of its financial impact, indication of the uncertainties relating to the amount or timing or any outflows which we may expect in future. Possibility of any reimbursement, anything related to this contingent liability is disclosed in the notes to accounts. So we'll see whether there is a present obligation as a result of obligating event. Is there any probable outflow? Can we estimate it? We create a provision. If anything is missing, if all the three criteria are met, we create a provision, we provide for it. If we cannot estimate it, but there is a probable outflow, there is a present obligation as a result of past event, but we cannot estimate it, we disclose it as contingent liability. If there is a possible obligation and the chances are remote, we disclose the contingent liability. If there is a possible obligation for an asset, if there is a possible obligation and the chances are very remote, we do nothing about it. Contingent asset is when we are expecting, like we have filed a case against someone and we are demanding money from them. It is in the court. We may receive that amount, we may not receive that amount. So arising for past event whose existence will be confirmed by occurrence or non-occurrence of one or more uncertain future event, not wholly within the control of entity. We cannot control that event. It may be in our favor, it may not be in our favor. So they are not recognized in accounts, as it may result in recognizing income that may never actually be realized. So we cannot record anything as part of the books. Even we are not required to even disclose this fact. However, if the entity is virtually certain that income will be realized, so virtually certain means this is no more a contingent asset. This is in the category of an asset now. Then the related asset cannot be recognized as a contingent asset. It is an actual asset to be recognized in the financial statements. So if it is uncertain, it is contingent. We may not even disclose. But if there is a virtual certainty, it becomes an asset. So the life cycle is very short, contingent asset to directly asset. But in case of a liability, the life cycle is from contingent liability, it jumps onto the position of provision, and then it actually becomes a liability. So disclose the contingent assets where an inflow of economic benefits is probable. Entity can disclose a brief description of nature of contingent assets on the end of the reporting period, and if possible, the estimate of their financial effect. If they are expecting some money to be received, but they are not sure of how much, when they may receive, but they can disclose this fact that they are expecting this amount and the financial impact of it. So we look at this chart, which can give us more clarity. If you notice the word probable, possible, present obligation. There is a present obligation, there is a probable obligation, there is a possible obligation. These words define actually whether it will be falling in the category of contingent liability or a provision or a clear-cut liability. When it says virtually certain, the chances are, likelihood of it happening are more than 95%. So it is not a contingent liability, but chances of it is a probable liability, it is going to happen. So we'll provide for it. In case of chances are virtually certain, we'll create an asset. Will not record it as a contingent asset. We know that this is going to happen. When the probability in the range of 50 to 95%, we'll again provide for it. If there is a possible obligation, the chances are in the range of 5% to 50%. We'll disclose the fact. And if the chances are remote, less than 5%, we may not even disclose it. Not in the case of contingent assets, not in the case of contingent liabilities. When the chances are remote, we may not even disclose it. But if there is a possible obligation, it is a contingent liability, will disclose it. If there is a possible expectation of receiving anything, no disclosure is permitted in case of assets. Only if the probability of receiving an asset is in the range of 50 to 95%, we disclose a contingent asset. And when that probability becomes virtual certainty, we disclose that asset in the books. In case of liabilities, if the probability is until it becomes virtually certain or actual amount, in the range of 50 to 100%, we provide for it, we create a provision for it.